Okay, so let's jump into the bank reconciliation that it talks about. So this is done to make sure that what the bank account is saying that you have in your cash account is actually what you have in your cash account, and making sure that what you have on your books matches what the bank has. Ideally, in your mind, it kind of sounds like, okay, well, why wouldn't the two match? But if you check it on a certain period where you have a lot of outstanding checks, or you have a lot of deposits that have not hit the cash account yet that you've recorded on the books, then you could run into some issues. So when doing the bank reconciliation, you want to break it down and look at it from the bank side of things and then the company side of things. So for the bank side, this means that you're actually looking at your bank statement. The thing that you want to take into account are deposits that you don't see on the bank statement, outstanding deposits that you know have been paid, and then checks that are outstanding that you know you've written, right? So let's say it's a situation where you wrote a check to pay the rent for the month, and you check your bank account on January 3rd, that check still has not cleared, right? That'll be a reconciling item when you're looking at the bank side of things, right? The bank is going to say that you have $15,000. However, you know you have this $2,000 check outstanding for the rent that you paid. It's been written. They said that they cashed it. It just hasn't came out of the account. So you would subtract these checks outstanding. These will be a minus to the bank side, and then this will be a plus to the bank side for the deposits outstanding. And that just relates to deposits that you've recognized on your books, but they have not came through yet. Maybe you get an email when the payment is made, or you're expecting a payment and you know that the payment was made. It just hasn't reflected yet on the bank side. So you have money in your account, or, even from a personal aspect, right? If you have a check that you take a picture of to deposit, it'll usually tell you that, like, hey, a part of this check is available. The remaining amount of it would be available in the next 2 or 3 days. That's something that you would account for on the bank side. On the company side, you want to look for fees, NSF fees, any type of account fees, unrecorded payments, or manual errors. These manual errors usually mean that we fat finger something, meaning that, hey, we wrote a check for $1,500 and we recorded the check for $15 instead of $1,500. So now we have a difference in our bank account because we said that we only wrote this check for $15 when it was $1,500. So you're actually going to have a rude awakening when you do check that. Unrecorded payments. Maybe the bank got a payment that came in that you guys didn't know was expected to come in. So what will end up happening is you'll check the account, you'll see that the payment came in, you'll need to record that revenue and that cash being received on the company side of things in your books. In the book, it also goes over the journal entries for these. The journal entries are relatively simple. If you understand the journal entries that we've done in the previous chapters, then you'll understand the journal entries as it relates to the cash account. If not, I can walk through a couple of those adjustment journal entries. You guys just let me know.